So hi guys, it's SJ speaking, and in today's video we're going to see about relative strength index. It is one of the indicators used in technical analysis. When it comes to technical analysis, there are two ways we can use the analysis. We can analyze the stocks. So one way is using the price action, that is candlesticks, chart patterns, the market structure, everything comes under price action. Whereas indicators, there are two types of indicators: leading indicators and lagging indicators. So leading indicators can be used to predict the stock price's movement, whereas lagging indicators just show the trend which is already going on in the market. So just shows the trend. It is also known as trend following indicator. So this is a relative strength index is one of the leading indicators. So it is also known as oscillator, momentum oscillator. So before going into the video, I am personally teaching trading mentorship course. So if you want to join my trading mentorship course, you can contact me in the number on the scrolling below on my video. So I am giving my course on a discount for the first 25 members. So if you are interested, you can contact me through that number. So let's go into the video right now. So what is relative strength index? So it is known as RSI. So you can here many would say that RSI indicator, RSI indicator. So this is what the relative strength index is known as RSI indicator. So it is one of the momentum indicators used in technical analysis. So it is a leading indicator which is used for predicting future price action movements. So what RSI does? It measures the speed at which the stock prices rises or falls. That is what momentum indicates. Momentum indicates the speed at which something happens. So it's the momentum. It's the stimulus. You can also say it's as a stimuli. So RSI is more reliable in a sideways market rather than trending markets. So RSI is more reliable in sideways market rather than trending markets. But RSI also works in trending markets. So, but it's more reliable on sideways market. So it is also known as momentum oscillator. So how this RSI can be used? It can be used in two ways. One by using the overbought and oversold region, and another is divergence. This divergence is very important. So even our Nifty 50 crash before Corona, this has been predicted by using the divergence. So this is very important. So what is oversold and overbought region? So RSI indicator basically has three reference lines. The upper band is default value is 70 and middle band is 50 and lower band is 30. So on the RSI length, it would be default length would be 14. But I have the settings of 7 for RSI length, and I have 80 here and 20 here, and the rest is same. You can have my settings or you can use the default setting. You can see which is accurate for you and you can use it accordingly. So how the overbought and oversold region is used, you can see here. As stock prices move, if the RSI falls below 30, then it is said to be in oversold region. So this is where the new investors, buyers enter the market. The demand for the stock increases here, but this is only an assumption. It might not always occur, but there is a high reliability to occur. So a buy signal is generated when the RSI moves from below to above the oversold line. So suppose here is the 30. If the stock price moves and cuts above, this is known as buy signal. So similarly, overbought region. If the RSI rises above 70, the stock prices is said to be in overbought region. A sell signal is generated when the RSI moves from above to below the overbought line. So suppose if 70, it moves and goes above, this is the sell signal. So there is a high reliability of for these things to happen, for a sell to happen or for a buy to happen. But this is not always true. Sometimes the stock might even go up to this falls below 30 and still be in the selling side. Many would not start to buy the stock even if it's below 30, and similarly many would not start to sell even if it's above 70. It might still go on. So it is not always accurate. So next comes the let's see an example. So you can see this is there is a real signals and fake signals. So if you thought it goes up and comes down, you can see this is the 70 zone, and this is the 30 zone, and this is the 50 zone. So you can see if the stock price grows up and comes down, this is the sell signal. But you can see clearly even though a sell signal is formed, the stock price went again upward. So if you have taken entry here and put your stop loss at close here, you would have taken a loss. But if you have kept the stop loss somewhere far away, you would have not have had a loss. So the still your trade would be ongoing. So this is the scenario. This is a fake signal and this is the real signal. You can see if you had sold here, you would have made a profit. So the stock price fall down, and this is a fake buy signal. You can see clearly if you have bought here, the stock price would have fall down and you would have made a loss. But if you have bought here, then you would have made a profit. So buy signals are not always, buy and sell signals by using the overbought and oversold are not always accurate, but there is a high reliability of the buying or selling to happen at the oversold and overbought region respectively. So this is what you can see, the fake signal and the real signals here. So this is what. So you can even buy at this signals and you can keep your stop loss far above. Your trade would not go into a loss. So this is the scenario. So this is the how overbought and oversold regions are used. So next comes divergence. So although when comparing these two, the divergence is more accurate. You can take entries using this divergence more than by using this overbought and oversold regions. So you can mainly use this overbought and oversold on sideways markets instead of trending markets. So, but RSI divergence, it happens in trending markets too. So, trending markets, RSI divergence occurs only in trending markets actually. So, RSI divergence occurs when the stock price makes a new high or low, but the RSI indicator does not make a corresponding same high or low. There are two types. One is regular divergence and another is hidden divergence. Regular divergence also has two types. One is positive or bullish and another is negative or bearish divergence. And hidden divergence also has bullish or positive, negative or bearish. This regular divergence is for finding the trend reversal, but whereas hidden divergence is used for trend continuation, for spotting the trend continuations. So, so regular divergence is for finding trend reversals and hidden divergence is for trend continuation. So wait a minute. So let's see the regular positive or bullish divergence. So RSI regular or bullish divergence in the stock price makes lower lows, but the RSI indicator does not make corresponding lower lows. So this is what lower low is. If you didn't see my market structure video, you see that video and you can learn what is lower low, higher high or higher low. You can see it is used to predict bullish trend reversals. So you can see this is the example. The price makes, whenever you are looking for bullish divergence, you must always look at the candles low. You should not consider the candles highs. So you should see the swing lows. So the swing lows of the market. These two are swing lows. So you can see it forms a lower low. You can see this is lower low and this is lower high and this is again lower low. So you can see if you didn't watch my structure video, watch that first. Then only you can understand it easily. So this is lower low is formed on the price, but the RSI does not make a lower low. It forms a higher low. So you can see, so higher high, higher low. So this is what bullish divergence is. So you can see the trend get reversed from bearish to bullish here. So you can also see the candlesticks pattern. You can see this is a bullish engulfing. If you didn't see my candlesticks part 2 video, watch that video. I will clearly explain about what are engulfing candles. So you can, after confirming the candle, you can take an entry and put your stop loss here and your targets accordingly. Target 1, target 2, target 3. So you might have made huge profits. So this is RSI regular divergence, bullish, and this is bearish divergence, regular. So stock price makes higher highs, but the RSI indicator does not make corresponding higher highs. This is used to predict bearish trend reversals. So you can see, you must always, in case of bearish divergence, you must always see the high swing highs of the market. Highs of the candles you have to see and join these two candles. This forms higher highs. You can see higher high, higher low, higher high. So higher highs are formed. Whereas RSI divergence forms lower highs. So this is the RSI regular negative divergence. Price goes up, the RSI comes down. You can confirm the divergence here and you can take an entry here by confirming the candlesticks. You can see this is the evening star, which I will explain in my upcoming candlesticks part 3 video. So, or you can use Fibonacci retracement. I have also put a video about Fibonacci retracement. If you didn't watch, you can watch that video. You can take the swing high and the swing low, and you can take 0.618 retracement or 0.786 retracement or 0.5 accordingly to your risk. And even here you can see the candlestick confirmation. You can see bearish engulfing and you can take your entry here and stop loss here, or you can put an entry here and stop loss here, or you can put your stop loss here and targets accordingly. So this is how you have to take entry by using this divergence. So this is the bearish divergence. So next comes the hidden divergence. So hidden bullish divergence or hidden positive divergence. So stock price makes higher lows, but the RSI does not make higher lows. So this is used to predict the bullish trend continuation. So you can see one easy way is to differentiate between regular and hidden divergence is if the bullish means you have to look at the lower low, you have to look at the swing lows. If the lower lows are high, if it goes above like this, then it is hidden divergence. If it goes the opposite direction in case of bullish, it's known as regular divergence. So in case of bearish, if it goes like this, it is hidden divergence. If it goes, if the price goes like this, it is regular divergence. So you can easily differentiate between this. So this is how the hidden positive divergence looks like. So RSI makes higher highs, sorry, higher lows, but you can see price makes higher lows, but the RSI makes lower lows. So this is how the trend will look. So you can see the continuation. You can confirm the divergence here, and after the bullish candle is formed, you can confirm your trend continuation, and you can take your entry and stop loss here, or you can put your stop loss here and your targets accordingly. You can put targets 1, 2, and 3 accordingly. So this is one of the most important techniques, indicator techniques used. By using the divergence, you can take your entries. And similarly, next is hidden negative divergence. The stock price makes lower highs, but RSI does not make the lower high. You can see the stock price makes lower high. So you can see lower low, lower high, and again lower low. You can see lower high. Stock price makes lower high, but the RSI forms you can see higher highs. So this is how it takes place. You can confirm your divergence at this place, and you can see the candlestick, whether there is a bearish reversal candle or any candle you can see. Or you can if you didn't take your entry here, you can also wait for one swing low to form, and you can use this swing high and swing low and take the retracement of around 61.8% or 50% according to your risk management. 61.8% is more accurate. So you can take your entry here and put stop loss and targets here accordingly. You can once when you're using technical analysis, you shouldn't use a single strategy alone individually. You have to combine several strategies and you have to confirm and take your entries. So your trade would be more successful when you are using more strategies together. That is what is known as confluence. So these are the four divergence. Sometimes the price might be like this, but the RSI would be flat. Whenever the RSI is flat, it is known as moderate divergence. You take any of these four divergence. If the price moves like the according to the its respective divergence, but the RSI is flat, it is known as moderate divergence. It is also known as extended or exaggerated divergence. So let's go into live chart. So these are the four types of divergences. So regular means trend reversal, hidden means trend continuous. So let's see graphite chart. So RSI, you have to go to indicators and press RSI. You can see relative strength index. So this will come here, and you can see the default setting would be 70, 30, and 50. But my settings are this, and inputs would be 14. But I have reduced to 17. 14 is the default setting. So you can also keep my settings, or you can use the default settings. You can see which is more accurate for you. You can practice in the live markets and see. You can see here you can take the swing high. You can join these two candles. So this the stock price makes higher high, but the RSI forms lower lows. So you can see this is a bearish trend reversal. You can confirm that it is a regular negative divergence or regular bearish divergence. You can see similarly. You can see here around here. So this is the divergence. This is negative bearish divergence. So you can confirm this. You can see the evening star is formed, or you can use Fibonacci after a new swing low is formed, and you can take a retracement and take a entry here. You can either take your entry here and put your stop loss and targets accordingly, or you can take an entry around this retracement level, and you can take your keep your stop loss accordingly, and you can keep your targets. So this is regular divergence. You can use this divergence in any time frames. You can use this in any from 1 minute to a month. Any time frames you can use, but higher time frames are always more accurate than lower time frames. So this is the difference between higher and lower time frames. Even you can use it in intraday trading. So you can see, we can see in this chart whether there is any divergence is forming. You can see here. So this forms lower lows. Price makes lower lows, but RSI doesn't make lower lows. It is almost flat. So this is what is known as extended divergence or moderate divergence or exaggerated divergence. For easy understanding, you can remember it as moderate divergence. So if the RSI would have been like this, it is called as a regular bullish divergence. But the RSI is like this, so it is a moderate divergence. So moderate divergence is less reliable when compared to normal regular or hidden divergence. Since it is moderate only, it's forming in a moderate phase, so it is less reliable. But still, you can take entry orders based on this. So it is a Harami candle is formed only once. After it breaks this candle, you can take your entry here. Sorry, you can take your entry around here, and you can put your stop loss at this mother candle's low. If you didn't watch my candlesticks videos, watch that, and you can put at this previous. So it went up to here. So you can keep your targets accordingly. 1 is to 1.5 minimum. So you can keep 1 is to 3. So 1 is to 3, the targets has been achieved. So you can see in live charts, even the Nifty 50 crash has been confirmed by this uh, divergence. You can see clearly. Before coronavirus occurred, there was a crash. During the coronavirus, the Nifty crashed. You can see here. The Nifty crashed here. You can spot the divergence clearly here. You can see. You can see the stock price makes higher highs, but the divergence was making lower lows. So you can see this is the scenario. If the divergence has been confirmed at this place, you can confirm the divergence after this falls quite a bit. And you would have taken an order around here. If you have taken your options, those who are doing options, if you are bought put options or you sold call options, you would have gained enormous amount of profits. A huge crash had occurred. So this is a bearish regular divergence. So this is the importance. This is the reliability, the high reliability of using this strategy, divergence strategy. So this is very important in case of RSI indicator. You can also and I am also forget to say another thing. There is a thing called zone shift. Zone shift. You can see there is a thing called zone shift. I will show you. In this strategy, overbought and oversold. Usually, in a bearish market, the stock price would fluctuate between 40 and 70. But if it takes support around 30 or resistance around 60, it can change from bullish to bearish market. Similarly, during a bearish market, RSI would usually move from 30 to 60. But if it takes support around 40 or resistance around 70, it is an assumption that the market is going to change from bearish to bullish. So this is known as RSI zone shift. So I forget to say this. This is you can in this first strategy, overbought and oversold. This is another additional information for you. So that's this video, guys. Hope you guys enjoyed this video. Make sure you give a thumbs up, share with your friends and family, and subscribe to my channel. And also comment if you like the video. It will give me motivation. It will motivate me to create more videos. And also press the bell icon on all buttons so you get notified for all my videos. And also, if you want to join my trading course, I am providing discounts for my course for the first 25 members. So if you want to join my trading course, call my number in the scrolling below. And also, if you want to join, if you want to open a Demat account, I have given you Zerodha link in the video description below. You can open your Demat account and start investing or trading from today onwards. So hope you guys enjoyed this video. So thank you. I will visit you on my next video. Until then, bye bye.